We're seeing a pattern. As I said, we have new highs followed by a brief pause, maybe a bit of a pullback, followed again by new highs. So what is your read here, Andy?
I mean, I think, Michelle, all you need to see is the amount of deliveries coming on the COMEX, and I can make it very simple. When I started talking with you about this stuff several years ago, it was about the central banks purchasing gold and the repatriation from the Bank of England and the New York Fed. But now it's progressed to massive deliveries coming on to the COMEX market, entities standing for delivery for billions and billions and billions and billions every single month for going on 16 months. At this level, that's all you really need to see. To me, that's all that is relevant. The people who are standing for delivery for literally in December, as an example, the largest delivery of silver in the history of the COMEX market in the month of December, somewhere in the neighborhood of 68 million ounces of silver. Who's standing for delivery for 68 million ounces of silver? Every month, 3, 4, 5 million ounces of gold or more. This is going on repetitively, and there is no one talking about it. To me, there's nothing else you need to see. So these pullbacks that we see, like we saw this morning, are, to me, not anything other than a gift. Now, it's hard for someone to really, I mean, look, short-term caution, sure, anything that's gone up this fast. Long-term bullishness, absolutely, they can coexist together. But I think that when you look at a market like this and see the deliveries, see the rate hikes in margin that do nothing but knock it down for a day or two, shaking the weak hands off, then it goes right back up, seeing the lease rates elevated forever, seeing the arbitrage in China at a $8 or $10 difference in price on silver. All of this stuff, to me, would have destroyed the price of gold and silver in years past, like it did in 2011, where they jacked the margin rates up and it never came back. Took 15 years. These things, this market is laughing it off. The people standing for delivery do not care about margin. They don't buy on margin when they're spending billions and billions and billions of dollars. And I just think that that is all you need to know. So when we see a pullback, to me, it is not about a whole new bunch of supply that has been dumped onto the market. It is about unwinding of leverage and of speculation and being shook from a position of rising margin responsibility and the selling that incurs as a result of it. But it always used to, when that happened, it would just fall and fall and fall and wouldn't come back. And now all of a sudden, it's like a speed bump and it comes right back. So to me, you don't need to see much else than to see the demand that is coming at the very highest level here in the United States.
So help us understand what standing for delivery means and how these contracts are usually resolved. I mean, people sometimes just pocket the trade in terms of the paper silver. Help us understand what that means to actually now say, no, actually, we want the physical silver with the futures contract, or the physical gold for that matter as well. And how does this compare sort of percentage-wise in terms of how often people actually stand for physical delivery?
Well, most of my career, which is almost 36 years long, no one stood for delivery. Less than 1% of contracts stood for delivery. And that
less than 1%?
Less than 1%. And that is what I've been screaming about for the last several years. And, you know, it started with a group that the COMEX calls the others. Now, they publish a report every week called the Commitment of Traders, which would show the positioning of the largest traders. And it was always just two subcategories: the commercials, JP, Goldman, Citi, the specs, the hedge funds. And one would go long, one would go short. And around 2021, we saw a third group of reportables that was added to this weekly listing of the biggest traders, and they called it the others. And they're still there. We believe them to be sovereign wealth funds in particular. But I started talking about in so many of my videos that something's going on here because big money is now standing for delivery. Now, I don't know the exact percent of it, but I will tell you is that the amount of deliveries that we've seen in the past 15, 16 months here in COMEX, on COMEX, is akin to 4 feet of snow in Death Valley in July. And I guarantee you they're not going to open up snowmobile dealerships if that were to happen in Death Valley. It's an anomaly in every respect of the word. And what does it mean to stand for delivery? That means instead of being cash settled for your contract or rolling it over for another month in the future, they are saying, no, we want the metal right now. and it's delivered into the COMEX ecosystem. A lot of it leaves COMEX, goodbye, and never comes back. Where is it going? We don't know. Is it going to China? Is it going to the Treasury via the Exchange Stabilization Fund? Who's taking it? Is it Tesla? Is it Samsung? Is it Sony? Who's doing it? Now, a lot of it stays in the COMEX, and there are two categories of holdings inside the COMEX. Miles Franklin has 8 Brinks facilities within its storage program. One is in New York City. That is JFK. That is a COMEX facility. I have clients that have a large amount of silver in 1,000-ounce bars in their account, and that's called eligible. Now, eligible means it is eligible to be sold, but it is not for sale, and my clients aren't going to put it into the COMEX anytime soon. Registered, on the other hand, means those bars that are backing the contracts that could stand for delivery. So what isn't leaving the COMEX goes into safekeeping ineligible inside of a Brinks vault or any of the other COMEX facilities where it's not for sale and it's just being held there for safekeeping. Because again, when you think about 68 million ounces, well, if a mint box of Silver Eagles, 500 ounces, weighs 42 pounds, how much do you think 68 million ounces weighs? And who's taking it? Where is it going? How much is leaving? The relevance of it is that it is standing for delivery. The COMEX was never really designed as a delivery mechanism, but in order to maintain credibility, all of these contracts have the ability to deliver instead of cash settling or to use as a hedge. Typically, if we look at these two remote controls here as inventory in my warehouse and a COMEX contract, if I have 3 million ounces of silver in my warehouse right here and the price falls by $10, well, I'm screwed. I'm down $30 million. But if I sold short the exact same amount, they go inverse of each other. The COMEX was designed originally to offset risk, but it's been turned into a delivery mechanism. And the biggest, most well-informed money in the world is doing this. And one of the things that I find to be shocking, Michelle, is the lack of media coverage of this. None, zero. And that's almost, fine line between conspiracy and reality. But where is journalistic integrity? Why is it that we have to talk about this all the time? And no one is saying who's standing for delivery for billions and billions.
Who is standing for delivery? I know I'm asking you to speculate here, but what are some of your theories on this?
I mean, part of me feels like it's the Exchange Stabilization Fund, like it's the U.S. Treasury. I mean, so far in January, which is not a delivery month, I don't know, somewhere around 40 million ounces has already been delivered. I haven't checked it, but I would assume that's about where it is. It was in the upper 20s last week. So even if you take the upper 20s and you add it to the 64, 5, 6 million ounces that was delivered in December, the largest ever, you're at roughly 100 million ounces in the last 45, 50 days that have been delivered. Now, is there any, I think, coincidence maybe that the government classified silver a critical mineral and they just passed a law saying that the government will put price floors underneath critical minerals within the next 90 days? I think that there is this fine line between, could it be Samsung, Sony? Could it be the government not telling us? If it's done under the Exchange Stabilization Fund, they don't need to get congressional approval. They don't need to tell Congress up front because it's for national security. Well, silver has now been made a priority for national security. And so I guess all I'm trying to say is that it's incredibly unusual, and the people at that level who are bringing in that kind of money, who have been following what the central banks have been doing, in my mind, that's all you need to see. And you can see that this is not a mania. It's not a mania because even though we're doing tremendous volume in business, it's not the volume that we saw during Silver Squeeze, where everyone was buying little bits, even a couple $1,000s, or where the public was starting to expand. Now, these are the people who we've worked with for a long time, or the people who have been watching you for a long time, or me, or others, who are finally saying, it's time to actually do something meaningful here. And we're seeing much larger orders. Our average order size right now is exponentially larger than it's ever been. These are people who are concerned, who are aware, and are seeing the same things that we're talking about, but they represent a tiny portion of the public. The public is still vastly unaware of this. And that's due to the fact that how do you explain that we have gold and silver at all-time highs and it's nowhere to be found on the mainstream media? It's not on 60 Minutes or on the cover of any newspaper.
It's, to be fair, it is starting to make headlines because at some point you cannot ignore these astronomical increases and rallies. It's not really into the how or the why, but you are starting to see headlines on the mainstream because you can't ignore it. You cannot ignore when silver is up almost over 185% year over year. You can't ignore that. Even financial mainstream media. But to your point, the whys and the details get glossed over. I do want to bring up something, Andy, because you said that this trend accelerated, the standing for delivery trend in the COMEX accelerated after President Trump returned to office. Is that a coincidence?
You tell me. Is there such thing as a coincidence at that level? I don't think so. And most of the media attention that you speak to frames it as it's reached its peak, it's topped, it's overbought. A lot of the things that I would argue, if there was really informed journalism, these things that are valid perhaps in a market that is freely traded, but a market like gold and silver, which has never been allowed to find real price discovery. And I think that's undebatable. I mean, that just isn't debatable that metals market have been suppressed for various reasons. We don't need to go down that road again. We've talked about it ad nauseum. But how valid is technical analysis in a market that has never been allowed to find price discovery? In a market where the West has controlled the paper price forever, but that's breaking. And it's breaking because of the standing of delivery, whether it be in London or the massively abnormal deliveries we're seeing here on COMEX. To be naked short in a market that is backwardation. Like, for example, let me just say one thing here. I want to read to you one thing. I mean, I think anyone that would be short in a market that is that is in backwardation, is as silly and stupid as a mud wall. TD Bank is one of these morons who, came out and they're one of the ones that are short. And they come out and they say to their public, they say, we enter short spot anticipating a dramatic reversal in prices as silver's devilish blow-off, framing it negatively because they're wickedly short. Blow-off top comes to completion. And it goes on to say, TD Securities entered a short position in silver futures in early January, betting the price would fall towards $40 an ounce. They placed a stop loss around $92 an ounce to limit losses if the price went the other way. What do you think happened last Friday? At a great expense to TD Bank, they got stopped out. If you play short in a market where you used to be able to do that and drive down the price not only through shorting, but through rhetoric, it would work and it wouldn't come back. Now, they knock it down, great. You got people that are standing for delivery for billions of dollars worth say, thank you so much, TD Bank. We'll take all of that and watch what happens to the price. And we're going to stand for delivery too. So you need to come up with that silver, not just a papered over payment instead of the real thing. It's an existential threat to these banks. And they proved it in a very, very short period of time, showing just what happens when physical demand overtakes paper manipulation. And that's why I've always felt that the only way you can successfully manipulate a market over a period of time, the way the Western central banks did, is to push it in the direction it's going. And they held it down. No one wanted it. But all of a sudden, there are some very sophisticated people and very wealthy people and very well-informed people, whether it be the central banks or whoever the hell is doing it here, or whoever has been draining the LBMA, and they're like, okay, fine, we'll play that game, and we don't play on margin, so go ahead and short it and watch what happens. And maybe that's why the Economic Times just came out and said, well, you know what? The 5 banks in the U.S., they're actually net long. It's the banks in Europe and the banks in Canada that quite haven't got that memo yet, and this would prove true with TD Bank.